Welcome, everyone. We'll just wait just a minute for everybody to arrive here. Okay, we're going to get started. Good morning, or good afternoon, I should say. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation is titled Summary of Tax Provisions for 2023 and 2024, and will be presented by Brenda Young at Stovall, Grundy, and Allen, or STA as they're known. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We have been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping about us. All of you have access to the chat feature. So if you have any questions, please don't hesitate to type those in, and we will be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email. So if you missed something, don't panic. You all have the ability to watch this again. And you are welcome to forward this presentation to any of our presentations to your friends and family if you think it would be of benefit. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking any action on the information that is presented today. For more information, including key disclosures, please visit our website at stripmatterwealth.com. There's our disclosures page. And you'll read all of the additional disclosures we have on that page as well. A little bit about me. I am the founder and CEO of Stripmatter Wealth. Started it in 2007, and you can read more about me on our website as well at stripmatterwealth.com. And that brings me to our presenter today, Miss Brenda Young. Brenda joined SGA in 1999 and became a partner in 2005. Brenda supports SGA's practice with extensive experience providing audit services and financial institutions and tax services to clients in a variety of industries. She completed college after marriage and children, and thus exemplifies dedication and determination in everything that she does. Brenda loves reading and also is an avid sports fan. She is married and has 2 sons. So without further ado, let me bring on Brenda. Give me 1 second here. And Brenda, it's all yours.
Good afternoon. So Josh kind of gave you a little bit about me. The firm started in 1972 and by David Stovall and Wendell Grundy. Mr. Grundy retired in 2017, and Mr. Stovall just celebrated his 90th birthday in December. So needless to say, he's really pretty much retired, but he still likes to come to the office. So today we're going to discuss key amounts, some thresholds, business loss limitations, itemized deductions, beneficial ownership information, which is a new requirement beginning in 2024, business expenses, capital gain considerations, and other items. Carol Allen joined the firm in 1983, and she became a partner in 1995. Our motto is it's more than numbers. It's year-round relationships. That's what our goal is. We want to be there anytime throughout the year that someone has a need. We're full service. We do provide tax, accounting, and auditing services to a multitude of businesses and individuals. And I've included our website that you can peruse at your convenience to get more information on the firm. So for 2023, the standard deduction, married filing jointly, is $27,700, and then it's set to go up to $29,200 for 2024. For single filers, it's $13,850 for 23, and is set to go up to $14,600 for 2024. Head of household is $20,800 for 2023 and $21,900 for 2024. Those individuals that are married but filing separately have the same rates as single filers. So some other thresholds, IRA contribution limits. If you're less than the age 50 for 2023, that's going to be $6,500. For those that are 50 or over, it's going to be $7,500. And these limits are set to increase by $500 for 2024. Simple IRA plan limits, those that are under 50 is $15,500. Those that are 50 or over is $19,000. And again, these are set to increase by $500 for 2024. 401k and other types of plans, the limit for under 50 was $22,500. And for those 50 and over, it's $30,000. These amounts are set to increase again by the $500 for 2024. And then there's also compensation limits. So for 2023, that compensation limit was $330,000, and that's set to increase to $345,000 for 2024. Profit sharing and SEP limits. The contribution limit for 23 was $66,000, and the compensation limit again was the $330,000. The contribution limit is going up to $68,000 for 2024, and then the compensation limit is going up to $345,000 for 2024. Social Security wage thresholds, we talked about this last year. Those are kind of going up at more rapid pace than what they did in the past. For 2023, the limit was $160,200. For 24, that's going up to $168,600. So for those that have IRA and other tax deferred plans, there are required minimum distribution rules. If you turned 70 and a half before 1/1 of 20, then 70 and a half was your required minimum distribution trigger age. If you turned 70 and a half after 1/1/20 or forward and reach age 72 prior to 1/1/23, then 72 was your age. For anybody that reached 72 after 12/31/22, the age is now 73. And the Secure 2.0 Act has a provision that will actually increase to age 75 beginning 1/1/33. So the year that you have your first required minimum distribution, you can actually defer that first distribution to April the 1st of the year following the year that you reach that required age. But you have to remember, if you defer it, then you basically will be required to take both your first and second required minimum distributions in the same calendar year. And I actually had a client that this came up on. They gave me a call the last week of 23, and they had attained the 72 in 22, and they had deferred their first required minimum distribution and didn't take it till April the 1st of 23. But they had not received another notice from their financial institution about their 23 required minimum distribution. And so, luckily they knew enough about it that they contacted me, and I told them, yes, you're required to have that 23 required minimum distribution taken by 12/31/23. And so they were able to contact their financial institution and get that taken care of before the end of the year. So that's just something I think you have to remember, because if the financial institution by some chance made a mistake on that April the 1st required minimum distribution and actually coded it as a distribution for the current year, then they might not provide you a notice. And the penalties relating to not taking your required minimum distributions are pretty stiff. So you want to do everything you can to make sure that you don't let that catch you by surprise. And then also don't forget that if you are required to take required minimum distributions, you can actually make qualified charitable distributions, which is basically where the transfer from your IRA is made directly by the trustee of the IRA to a qualified charity. That amount is limited to $100,000 per individual per year. And if you do this, it counts towards your individual required minimum distribution, but it doesn't show up as taxable income for you, and therefore you don't really get a charitable deduction. And where this comes in to play, there are some thresholds that are triggered by what your adjusted gross income is. And so by doing it this way, your adjusted gross income is lower because it doesn't reflect that required minimum distribution. And obviously, since you don't have to pick it up in taxable income, then you don't get to turn around and take a deduction for it. It basically is like it takes care of that required minimum distribution, but it's just kind of a wash between the two things. So that's something to keep in mind. So one of the things that was part of the Tax Jobs and Cuts Act that was implemented at the end of 2017 was it implemented these business loss limitations. Well, due to the pandemic, they temporarily suspended those limitations, but in 2021, the temporary suspension went away. And so basically, this limits the amount of trade or business deductions that you can offset non-business income with. And so for joint filers in 2023, that limitation is $578,000. All other filers, it's $289,000. These amounts are set to increase to $610,000 in 2024 for joint filers and $305,000 for other filers. Any losses that you have in excess of these amounts are carried forward to future years. And where this comes into play is, let's say that you have income that passes through to you from a business endeavor, or you just have a Schedule C business endeavor that has a loss. Basically, for a joint filer in 2023, if that business, say, showed a loss of $600,000, only $578,000 of that loss would be able to be utilized to offset your other non-business income. The other $22,000 would basically be carried forward to future years. So on itemized deductions, we talked about this a little bit last year. one of the things that you can do to basically, if you consider a couple of years in the aggregate, that can actually get you a little bit more deduction, is to what we call bunch itemized deductions. And so let's assume that you have a married couple that typically makes annual charitable contributions of $30,000. And their real estate taxes are $12,000 each year. So basically, if you just look at a standalone year, that would provide them a total of $40,000 in itemized deductions. Because remember, one of the things of the Tax Jobs and Cuts Act was that it did limit the state and local tax deduction, which is referred to as the SALT deduction. It limited it to $10,000 per year. So even though their real estate taxes are $12,000, $10,000 is all that they're able to take a deduction for in a calendar year. So that would give them $40,000, which actually, for a married filing jointly in 2023, the standard deduction is $27,700. So, that they have enough to itemize. But let's say that they went ahead and decided in December of 23 that they were going to go ahead and prepay the $30,000 of contributions that they typically were set to make for 24. So if they did this, then now for 23, they would actually have 70,000 of itemized deductions, because they've got the 30,000 charitable deduction for 23, plus the 30,000 of charitable deductions that were for 24 that they actually prepaid before the end of 23, plus their $10,000 allowable deduction for their real estate taxes. And then in 24, they could actually take the standard deduction, which is set to go up to $29,200. So if you consider both years in the aggregate, that gave them a total deduction of $99,200, as compared if they did each year on a standalone basis, they would have $80,000. So by bunching the charitable contributions like they did, by prepaying the 2024 by the end of 23, they actually reduce their net taxable income another $19,200 when the 2 years are taken into consideration. Now, one thing that I would say, that if you decide to do this, you might want to make sure that the charitable organization is aware that you're actually prepaying those 2024 contributions, or whatever year you do it, that you're prepaying for the next year, because they may think, well, we're getting a windfall in now, but we're still going to have their contributions on a monthly basis, or however you usually pay those. And so I think it would probably be good to actually let them know, just so they're not caught off guard when you don't make any payments to them in in the 24 year. So one of the new requirements this year is beneficial ownership information. The Corporate Transparency Act that was enacted as part of the National Defense Act for 2021 mandates that millions of entities report their beneficial ownership information, which is kind of referred to as the BOI, to the Financial Crimes Enforcement Network, which is referred to as FinCEN, beginning in 2024. So new entities created in 24 have to file within 90 days of its creation. So let's say that basically you started a new business in 24, that you had to register with the Secretary of State, and you started it March the 1st of 24. You basically have 90 days from that March 1 date to actually do this filing. For businesses that are created after 2024, that window is actually going to go down to 30 days. So let's say that you started a new business March the 1st of 25, then within 30 days of that, you've got to actually do this filing. For existing entities, which are the ones that were created before 2024, you basically have all of the calendar year. You have to file by January the 1st of 25. There are a few exemptions, what they deem to be large operating entities. And basically, those are entities that employ more than 20 people in the U.S. They had gross revenue greater than $5 million on their prior year's tax return, and they're physically located in the U.S. Publicly traded companies that are registered under Section 102 of the Sarbanes-Oxley Act are also exempted. And then there's 23 specific types that are exempt that you can actually find on FinCEN's website. One of those, like banks, are exempt from this. So the beneficial ownership information refers to identifying information about the individuals who directly or indirectly own or control a company. FinCEN has like an e-filing website where you actually go out to do this filing. It's boiefiling.fincen.gov. Reporting entities are domestic reporting companies, which include corporations, LLCs, and any other entities that are created by filing a document with the Secretary of State or any similar office in the U.S. There's also foreign reporting companies and that's basically if they've actually registered as doing business in the U.S. Beneficial owner is someone that exercises substantial control over the reporting company or owns or controls at least 25% of the reporting company's ownership interest. And so when you talk about substantial control, typically like a senior officer, president, CEO, CFO, that would be somebody that actually has substantial control. Someone that has authority to appoint or remove officers or a majority of the directors of a company, basically an important decision maker, and any other form of substantial control. If you've opened any bank accounts for a business entity, I'd say I don't remember exactly, I think like since 2018 and forward, you've basically had to complete this information for the financial institution because they've been the one that have been responsible for actually filling out all of this. And now they're trying to shift it where basically you have to do the reporting yourself. I know that, there are some accounting firms, I think we have kind of made the decision that we'll be willing to help our clients file this information. So if anybody needs any help, they can certainly contact us. But just, keep in mind that if you have filed with the Secretary of State, any business entity, you are going to be required to do this by January 1 of 2025 for any existing businesses. And then you need to keep the 90-day rule, anything that's created in 24, and then after 24, any new entities within 30 days. So business expenses, one thing for 23, all of those business meals reverted back to being just 50% deductible. I don't know if you remember or not, but for 21 and 22, there was a temporary 100% deductibility clause in there for any business meals that were purchased from restaurants. Entertainment expenses still remain zero deductible. One of the things with the Tax Jobs and Cuts Act, from 2017 is we did have bonus depreciation. We had 100% bonus depreciation for eligible property, which basically was property that had a tax life of 20 years or less. You got to take 100% of that property off in the year that you purchased and put it in service. That expired at the end of 22. For 23 and 24, that 100% is reduced to 80% for 23 and 60% for 24. And there's further reductions each year until it's basically fully phased out as of 12/31/26. And so like for 23, it doesn't mean that you only get to take 80% of the total cost of eligible property off. What it means is that you get to take 80% immediately, and then that remaining 20% of the cost is depreciated like normal over whatever that tax life is. And it'll be the same thing in 24. You'll get an immediate write-off of the 60% of the cost, and the remaining 40% will actually be available to depreciate over the life. For instance, if you have something that has a 5-year life for tax, that 40% will be depreciated over that 5 years. The standard mileage rate for 2023 for business miles was 65.5 cents. This increased to 67 cents per mile for 2024. So some capital gain considerations. Long-term capital gains, which are those properties that you held for greater than 12 months. We have a 0%, a 15%, or a 20% tax rate, depending on what the taxpayer's taxable income level is. For 2023, for single filers or married filing separately that have income of $44,625 or below, basically fall in that 0% for long-term capital gains. Head of household filers, the income of $59,750 or below fall into this 0%. And then married joint filers who have income of $89,250 or below fall into the 0%. The 15% applies to those gains for single filers who have income above or from the $44,626 up to $492,300. Marrying filing separately is the $44,626 up to $276,900. Head of household is income of $59,751 up to $523,050, and then joint filers is $89,251 up to $553,850. And then basically the 20% applies to all of those gains that exceed the 15% limits. For 2024, these amounts are increasing slightly. The 0% for single or married filing separately filers, that's going to increase from income of $44,625 up to the $47,025. Head of household is going to be increasing from $59,750 up to the $63,000. And then the married filing joint filers are going to increase from the $89,250 up to $94,050. On the 15%, the single filers, the top amount for 23 was $492,300. That's increasing to $518,900. And then the married filing separately, the top number is increasing from $276,900 up to the $291,850. Head of household is increasing from $523,050 up to the $551,350. And then joint filers is increasing from $553,850 up to $583,750. Again, the 20% applies to any gains that exceed those 15% limits. So proper planning can eliminate or lower your tax burden that's associated with capital gains. For example, if you have large capital gains, you can consider selling other capital assets that have losses, especially if those assets aren't expected to recover your cost. On the flip side, let's say you have something that basically created a capital loss, and that's the time that you'd want to consider actually maybe things that you have that have appreciated in value. You may want to sell those to have the gains to offset the losses, because let's say on a married filing joint tax return, if you have excess capital losses, you're limited to only getting $3,000 in a tax year, and then those losses carry forward. So you never want a situation where you have large capital gains one year, and then the next year you have these large capital losses, and you don't really have any assets that you could sell to create gains to offset that, because you've paid your tax in one tax year on those gains, and then the losses basically carry forward. So it's going to take you a long time to recuperate that money by only getting, say, $3,000 a year. So you just want to take that stuff into consideration just from a tax planning perspective. Another thing is you want to make sure, if at all possible, you hold those assets for more than 12 months so that they do qualify for the lower long-term capital gain rates. Because remember, if it's a short-term capital gain, then basically it gets taxed at your ordinary income rates. One thing to remember, and I've actually had some questions about this recently, is there is an exclusion for the sale of your personal residence. Married or joint filers, they basically can have a gain up to $500,000 on the sale if it meets the criteria to be counted as their principal residence, that they don't have any tax consequence. For all other filers, it's a gain up to $250,000. And basically you have to have owned, and it has to have served as your principal residence for 2 out of the last 5 years. And so, you want to keep that in mind, especially I've seen situations where, say, an individual sells, their principal residence, and depending on what the market is, like with the high interest rates that we have now, sometimes these houses are not selling as quickly. So then they decide, well, if we can't sell it, maybe we should just turn it into rental property and start renting it. Well, if you have a very large gain in it, I would certainly keep that in mind, that you may not want to get outside of that 2 out of the last 5 year window, because then basically 100% of that gain, if it doesn't meet that criteria for your principal residence, whenever you sell it, you could actually then be subject to capital gains on the entire gain. So some other things just to kind of keep in mind. So with the Republicans in control of the House and the Democrats in control of the Senate and the White House, we really are not anticipating that there'll be any major tax changes in 2024. If there are any, my guess is it would have to be probably after the presidential election. But we do have numerous tax provisions that are set to expire at the end of 25. And there were and we'll talk about those in just a second, but there's quite a few provisions that were part of the Tax Jobs and Cuts Act that, if nothing is done, those were deemed to be temporary, and so they are set to expire at the end of 25. There are some things that you need to pay close attention to in some of these things that are set to to expire so that you can take advantage of them as they currently are for wealth preservation while they're, still available. So the annual gift tax exclusion was $17,000 in 23, and that has gone up to $18,000 for 24. And basically, that's where you can give any one person up to $18,000 without having to file a gift tax return or it going against your lifetime gift tax exemption. For a married couple, that is actually $18,000 per person that is the donor and the recipient. So for instance, if, say, a husband and wife wanted to gift their daughter $18,000, where they could basically gift her, each one could gift her $18,000. And so that would be a total of $36,000 that they could actually gift her in 24 without it having to file a gift tax return or it going against their gift tax exemption. The lifetime estate and gift tax exemption has gone up to $13.61 million in 2024. That it was $12.92 million in 23. So this is one of the provisions that is set to reduce, basically effective January 1 of 26, where it's going to go back to the pre-Tax Jobs and Cuts Act threshold, which was $5 million that is adjusted for inflation, which we're estimating that's probably going to be somewhere around $6 million. Well, if your estate is higher than that, looking at a 40% estate tax rate, that's kind of a huge impact to go from 13.61 million being excluded to only being 6 million excluded. So, that's definitely something that I think you should keep in mind. A few other things that I don't have on the slides is there are Roth retirement accounts that you basically could transfer, like a traditional IRA, you could transfer it to a Roth and do what they call a Roth conversion. You have 60 days where you can actually roll them over into a Roth, or they can be transferred trustee to trustee. The benefit of the Roth is that if you have the money in a Roth for at least 5 years, then basically if you're over 59 and a half, you can take a withdrawal and it's no longer taxable income. Now, at the time you take a traditional and you convert it, you are going to have to pick it up in tax, but sometimes, especially for younger taxpayers, when you consider what the amount is now versus what the amount, the potential it will be after you've had it in there for a number of years from an earning capacity, it may actually be more beneficial to pay the tax now so that then later when you take it out, none of it is taxable. So we talked about that there are quite a few tax provisions that were temporary in the Tax Jobs and Cuts Act that will expire at the end of 25. One of those is one of the things the Tax Jobs and Cuts Act did is it did lower the tax rate bracket for individuals. The highest rate is the 37% right now. That's actually set to go back to the pre-Tax Jobs and Cuts Act at the beginning of 26, which is 39.6. The standard deduction almost doubled under the Tax Jobs and Cuts Act. Those are actually going to go back down to the pre-Tax Jobs and Cuts Act, and then they'll be adjusted for inflation beginning 1/1/26. Personal exemption deductions were eliminated under the Tax Jobs and Cuts Act, and then basically we'll go back and they will revert to the pre-tax Jobs and Cuts Act beginning in 26. The child tax credit is currently $2,000 per child, but that's going to revert back to the pre-tax Jobs and Cuts Act of $1,000 per child. Right now, under the current provisions, there's also a $500 credit for other dependents. That basically will expire at the end of 25. Itemized deductions. One of the things that the Tax Jobs and Cuts Act was it increased the threshold for charitable contributions up to 60% of your adjusted gross income. That will revert back to the 50% at the beginning of 26. Now, we talked about earlier when we were talking about itemized deductions that under the current provisions, the state and local taxes, you're limited to $10,000 per tax year to deduct. So that cap will be removed, which is a good thing because we have, a lot of taxpayers with the way real estate taxes have continued to escalate the last several years, where their real estate taxes are by far larger than the $10,000. So there is some changes like with mortgage interest. You're limited right now on mortgage interest to the interest associated with the first $750,000 of the loan. That will go back to the $1 million. Home equity debt right now, interest on it is not a valid deduction unless the proceeds were used directly to improve the property. That will revert back to the pre-tax Jobs and Cuts Act, where the first $100,000, the interest on that first $100,000 would be deductible. One of the things that a lot of people, I guess, got caught off guard with the Tax Jobs and Cuts Act was it really eliminated the miscellaneous itemized deductions, which, one of the more common, I think, that caught a lot of people by surprise was unreimbursed business expenses or employee expenses. And that will revert back if they don't make any changes, where you actually will get a deduction for those that are in excess of 2% of your adjusted gross income. Now, another thing that we had before the Tax Jobs and Cuts Act was if your adjusted gross income exceeded certain limits, your standard or your itemized deductions would be kind of reduced down once you went over that limit. Well, the Tax Jobs and Cuts Act removed that limitation, but if it's not extended in 2026, that will revert back to the 3% reduction if your adjusted gross income does exceed those limits. One other thing, well, there's a couple of other things that if anybody has pass-through income that's come in from on a K-1. So the Tax Jobs and Cuts Act did provide for a Section 199A deduction, which was the qualified business income deduction, where you could take 20% of that income off to reduce it. And they did that primarily because there are so many S corporations and such that the income flows through to the personal taxes, but when they reduce the corporate tax rate to the 21%, it kind of, I guess, made an uneven field there, because if it was flowing through to an individual, there was really more tax consequence. So they implemented this 199A deduction to help, I guess, level the playing field a little bit more. So that will actually go away at the end of 25. And then we talked about the business loss limitations where you're limited up to a certain dollar amount, and then any excess losses carry forward, that will also be eliminated. So one last thing we talked about briefly last year is they had come out with information where, like, payment card transactions, anything over like $600 could be reported to you on a 1099-K. That includes like Venmo, PayPal. I mean, some of those. And so prior to this, they originally had kind of looked at the payments had to exceed $20,000 and there had to be more than 200 transactions. And then basically this requirement was going to make it where if it was over $600 and there was any number of transactions, that it would have to be reported. Well, at the end of 22, they actually said, okay, this is going to be a transition year, so you don't necessarily have to report. Well, they've actually delayed that again. And so my understanding is the IRS is looking at maybe increasing that threshold to $5,000 for tax year of 24. Our biggest concern is that we're afraid that there's income that could actually be reported that is really not true business income. And, then you have the whole problem of the IRS trying to match up these 1099s to your tax returns and stuff. So I guess we'll just have to stay tuned to see if, what they end up doing in 24. So that's really all I had prepared to talk about. Does anybody have any questions?
Brenda, great job. Great job. Thank you very much. I'm gonna, if you have any questions, folks, just type it into the chat box and we'll be happy to answer any questions that you have. And then you see her email there, her phone number's there. If you have a question specifically for Brenda, you're welcome to give her a call. While we're waiting here, I'm going to switch this back over.
Okay.
If you have any questions for us, you're welcome to give us a call at that number below. You can also go to our website, streetmatterwealth.com, or email us at info@streetmatterwealth.com. We also have a new QR code. If you'd like to schedule an appointment with us, you can click on that QR code and it'll take you directly to us to schedule an appointment. Brenda, that was a lot of information. And, I think a lot of it was just indexing upward for the year, right?
That's correct.
I think the big question is what's going to happen in 2026?
Well, and depending, we never know how the election, will come out in 24. There's always the possibility that some of these things that are set to expire at the end of 25, they may make them more permanent in 25. I just really don't, with the presidential election this year, I really don't anticipate, from what I've seen, there really being much change for 24.
Yeah. But still some valuable things to utilize to reduce taxes, as you talked about. The bunching strategy works great if you're giving a lot to charity, I think. And then obviously the Roth conversion you talked about, the capital gains strategies that you talked about. So there's always ways to reduce taxes. You just have to be a little bit more proactive in doing it.
Right.
But
well, and I think, to me, one of the things, especially from a wealth standpoint, is, I just would hate if people have the ability of doing like gifting now while the lifetime gift tax exclusion is higher. You just really hate. I mean, you talk about there's if it goes back to the pre-tax Jobs and Cuts Act, you're talking, roughly $7-8 million that now is potentially going to be subject to the 40% estate tax. if somebody dies. Well, that's a huge dollar amount, of tax consequence. One thing I will say that, I would hesitate in gifting like stocks and things like that that have appreciated in value, because if you do gift, then your cost basis transfers over to the recipient. And then now all of a sudden, if they sell it, they're still looking at a gain based on what your gain was, as opposed if they inherited it after you are deceased, then they get that step up in basis. So you have to look at those kind of things as well.
Sure. Yeah. But I do agree with you, gifting the $18,000 per year per person is
That's
a
kind of
really
a
easy.
no-brainer.
Yeah, it's an easy thing to do to help reduce the estate size. And there's different strategies for how to do that also. But just to clarify, that's $18,000 per person. And so I can give $18,000 to my three daughters. My wife can give $18,000 to our three daughters. So
Absolutely.
you can give a lot of money away if you want to work hard at it. But the advantage of that is that it doesn't go against your lifetime exemption. So yeah, that's an easy strategy. Well, I don't have anybody raising their hand here. So Brenda, as always, very informative. Thank you so much. We greatly appreciate it.
Thank you.
You bet. Have a good day. Bye-bye.
Uh-huh.